All right, Teaser with Channel Mortgage Partners, and we're looking at this past week, a look into markets, what happened, when did the week in the red, when during the week we're already in the green and it was getting better. But as we heard the Fed speech and what happened, things got a little bit worse. So this past week, home loans rates edged higher from recent lows and the 10-year yield ticked back up to 1.6%. It was all about the policy and response from the Fed and the administration and the subsequent market response. So let's break it down. No, it's not time yet, said Fed Chairman Jerome Powell. The Federal Reserve met this past week and essentially said they are not even thinking about raising rates or during their bond purchase program. They said inflation will rise in the coming months, but the increase will be transitory or temporary. Ironically, the Fed used the same terminology to describe persistently low inflation for the previous decade. Let us hope the Fed is right this time and that any rise in inflation is only transitory. Any meaningful and sustained inflation will be bad for the economy, the financial markets, and the rate. The U.S. economy is humming. Recent economic reports and corporate earnings have been strong. We've seen everything just start to boom as the markets opened again. The vaccinations and state reopenings have bolstered consumer confidence and consumer spending and lowered the unemployment rate. Housing remains scorching hot and in record demand. It is estimated that the gross domestic product for 2021 could be as high as 8%, a historically very high figure. If everything is so positive in the economy, do we need such an enormous policy response from the Fed and the administration? That is the big question. And we will continue to see the market's response in the weeks and months ahead. Bottom line, guys, rates have ticked up a little from the recent lows despite continued Fed bond buying, and as mentioned above. And as those thinking about looking into today's rates should do so, it's a very hot market. We know rates really didn't move up much this week. It's an extraordinary opportunity for most people to take advantage of. And even though there's a lot of competition and it's taking a lot longer just to get your offers accepted, still a great opportunity to get yourself in there. Find out what you can qualify for, find out who can help you, so that way you can finally get yourself into first or maybe a second or third property. Looking ahead in jobs week, likely the most important economic report of the month will be next Friday's job report. The numbers continue to improve as economies reopen. It is estimated that the unemployment rate will be in the mid 4% by the end of the year. Now that the administration has laid out the jobs and families plans, we will have to watch Congress and debate, negotiate both the spending and tax sides of the plans. The process, which is generally not fun to watch, could help bonds rates uncertainty elevate. Remember, bonds and rates like bad news and uncertainty, and for the moment these are good times, and the continued policy response by the Fed should help fuel housing for the foreseeable future, so let it roll. And as I mentioned before, if you guys have a scenario, you have any questions, or you want to see if you can get pre-qualified for a particular property, feel free to reach out to us. We'll provide you with a personalized mortgage report to see if it makes sense to make a move now, or if you're thinking about refinancing, see if it makes sense for you to take advantage of today's low rate. As always, share, like, comment, let me know what you guys think. Thank you so much.